Hello, everybody, and welcome to the Like a Tortoise channel once again. Before I discuss the next company, I want to say that remember that on the 20th of December, we have our first live event here on YouTube. So if you haven't done so already, just click that notify button so you don't miss out on it. This is going to be an opportunity for you to ask me or any questions from personal questions, questions related to stocks. So yeah, I'm looking forward to getting to know you on that call. And as always, thank you so much for the ongoing contribution. I can see that the number of subscribers continues to grow almost on a daily basis. So it's nice. It's good that it means that that we are delivering value, right? And that's by far the most important thing that we want is that you guys can benefit from the content. We don't share things for financial. We don't share here financial advice. That's not the goal. The goal is to share exactly what we are doing with our money. Skin in the game, very important for us, and also to see where there might be opportunity. And that feeds into today's goal, and that is to discuss a company that has been a stellar compounder over the next several years. And one of the people in our WhatsApp group asked me to do that, to do an analysis here for regarding an analysis of this company because he works there. He works at Visa, and he wants to know whether he should sell some of his shares or not. And so this is what I will try to assess in today's video. Okay. Before I also want to say that if, like him, you, for example, are working at Visa, you have an edge over me. Okay. And Peter Lynch talks about this many times in his books. In fact, if you don't know Peter Lynch, you should Google him. He's one of the best investors of all time. And he says that people that are working at a specific company already have a good understanding of the industry and the company, and probably a good understanding of their competition. And so because you are in that position, you talk to your colleagues on a daily basis. You see what management is doing. You see what kind of value the company is putting out. Okay. And so you understand the culture of the company. You are in a more favorable position than anybody, right? But and so try to understand that. Okay. But once you are past that stage, then the goal is, but what do the financials tell me? And that's part of what we are going to discuss today. All right. Fantastic. So let's do that now. If you don't know Visa, I mean, you would have to be living under a rock. One of the things that I do before deciding whether or not to invest in a company is to do a deep analysis into the business. Okay. I like to understand everything, and these are all the questions that I try to answer. Do I understand the business model? Do I think management is capable? Does the company have a sustainable competitive advantage? Is the company active in an attractive end market? And then that ends in the question: should we invest in the company? This is a full report that I created specifically for Visa. I shared it in our school community group a few months ago because this company has been on my watch list for a long while, and yeah, there's a lot of work that comes into play here. But today, for the sake of simplicity, I will try to just discuss the financials as I normally do. But let's just say that Visa is a phenomenal business. Okay, they operate as a payment technology company rather than a traditional bank or lender. It facilitates electronic payments globally, but does not issue cards, extend credit, or set interest rates, which is something that I really admire about the company. They operate such a capital-light business model that allows them to scale very efficiently while reducing their costs and achieving operating leverage. And sure enough, you can see I even took the liberty to do that. Look at that. It facilitates business models widely described as capital light. It facilitates digital payments without taking on credit, relying on transaction fees. leverages an established network with low incremental costs, resulting in high profit margins, strong free cash flow, and high returns on capital, unlike traditional banks that lend money. All right. So it's phenomenal. And this kind of scale and networks cannot be easily copied by competitors, which is part of the reason why Visa has maintained its strong competitive position over many years. And it's very hard to disrupt. Good luck with that. But let's then talk about the financials here in more detail. You can see right off the bat that this company has been pulling back since its all-time highs around March 2020, no, February 2025. Okay, so it's come off the highs, and it's trading at a forward PE of 25. I think this might be one of its lowest valuations, one of its lowest valuation levels in history. And the reason is fears of AI disruption. Not many things can cause the stock to come down, this one to come down, but AI has been widely discussed, as we know, and many say that it can disrupt the network. So, I mean, we will see. Okay, but let's talk about the company's financials. Even with all the AI buzz and all of that, what you can see is that total revenues have been going up very nicely since 2015. Look at that. My neck aches. Since 2015, the revenue has compounded by about 11% per year. I love that. You know that I like to see revenue going up by about 11%, by at least 10% per year over the very long term. So that box is definitely checked. And look at the consistency. Staggering, right? Fantastic. I love that. Let's talk about the operating income. Look at that. 11.32% at about the same pace as revenue. Also well above our threshold of our preferred threshold of 10%. So pretty cool. What about net income? This is where you can see how profitable the company is. Net income has gone up a bit. Well, has compounded at 12%, so faster than revenues. Okay, because of that scalability of the business. Again, also above our preferred threshold of 10%. Again, notice the consistency here. All right. I love seeing that, and of course, diluted shares outstanding have been coming down sharply since 2015. It means that the company is buying back shares, yeah, which is one of the main, which will unlock future shareholder value. And you can see that since 2015, the company has bought back around 20% of its own shares, which is very good. Okay, diluted earnings per share. Look at that. Because of the buybacks and because of profitability increases over time, they have been managed to increase diluted earnings per share by about 14.6% per year. Outstanding. I love to see that, and I also love to see the consistency in the numbers. Look, there's not much to discuss here in the income statement. I like what I see. Okay, let's look at the balance sheet. Let's look at assets going up by about 10%. Very good as well. What about total cash? They have managed to look at how profitable they are. Okay, almost about 19 billion in 2025. This is a yearly. That's staggering. Okay, very cash rich. Let's have a look at liabilities. Liabilities have gone up by about 20.53%. But let's look at total assets minus total liabilities, and that is book value. And you can see that book value hasn't gone up as much, only about 2.42%. But remember that book value makes more sense if the company has a lot of assets. Okay, and that, so in the case of so how can I say? It makes more sense if because Visa is such a capital light business model. Book value is not something that you will be paying too much attention to. Okay, It's more for capital intensive businesses, but still, you can see that book value has gone slightly up over time, and the trend is up indeed. Okay, so what about long-term debt? You can see that long-term debt has remained pretty stagnant here since 2020. It has come just slightly lower, but no, it's remained pretty much the same. We have to understand the maturity of that debt as well. That's important. Look at current debt. You can see that it jumped significantly in 2025. Again, what happened here? Yeah, we need to understand exactly what caused this spike. Why has the company issued more short-term debt, and check the maturity of this debt as well. Okay, but you can see that, look, current debt is debt that the company will have to pay in less than a year. It's about 5.6 billion, but again, they have 17 billion in cash and cash equivalents. So they have enough to cover all of that debt. And sure enough, if I go here to statistics, you can see that you can see, look at that, cash and cash equivalents about 16 billion. And then you see they have net cash is negative, but this includes total cash minus total debt. I wanted to see the long-term debt only instead of total debt. So and we already, well, sorry, I wanted to see the short-term debt. So they have enough cash to cover all their short-term liabilities, which means they are in a very good position. And sure enough, look at the current ratio is well above one. Okay, so you do the current assets divided by current liabilities. This gives them a lot of capital to get rid of all. It allows them. They have enough cash, okay, on the balance sheet that will allow them to cover all of their short-term liabilities. Okay, which is something very good. In addition, look at the low levels of debt relative to free cash flow and relative to earnings before interest, tax, depreciation, and amortization in equity. You'll know that I like to see debt to free cash flow below 3, which means that the company could pay all of its debt in less than 3 years of current free cash flow. That is certainly the case. All right. Look at the equity, debt to equity 0.69, very good as well. And debt to EBITDA 0.92, which is also very, very good, under 3. And the interest coverage ratio, this tells you how well the company can cover the interest payments on the debt. Ideally, I like to see this at about 8% or greater. The higher, the better. And sure enough, the company has plenty of, they generate a lot of income from the operations. Yeah, to cover all so they generate a lot more income from operations, right? So EBIT, which is operating income, to more than enough to cover all its interest expenses. So very, very good. I would say this is a very, very stellar balance sheet. And we already discussed the income statement as well. All right. Now let's have a look at let's have a look at the metrics, because we haven't covered margins as well. Look at this. The big where when the margins can consistently remain high over a period of say 10 years, this tells you that the company does have a moat. And sure enough, look at the gross margin. All right. So the medium is about 81.29%. Look at the consistency of these gross margins. Fantastic. Let's zoom in. Let's look at the quarterly chart. It's actually going up slightly ever since December 2024, which is very good. Okay. I love seeing these gross margins. Now, operating margins are very important as well. And sure enough, look at the consistency of these margins again. Since 2011, that is incredible. Gross operating margin of about 66.39%. Man, this company is definitely very profitable. And in fact, I think I can check that here in my model. I think they have a cash conversion ratio of above 100. Here we go. Cash conversion ratio, guys, if this is the first time you are looking at this, is something that I like to pay attention to, because it tells you how much of the operating cash flow. Sorry, it tells you, as you can see right here. All right, it tells you how it tells you how much of the net, how much of the company's profits are translated into cash, right, into operating cash flow. And that is something that I really like to see. Sure enough, if I keep this here, I always have this measures how efficiently businesses can turn profits into actual cash. Okay, and so very profitable company, which can be found, which can be easily noticed just by looking at their margins. Free cash flow margins of about 53%, net profit margin right here. Okay, look at net profit margin around 49.64%. This is crazy. And the free cash flow margin, as I mentioned, around 53.94% as well. Also in line with the median. That's incredible. Okay. Now let's have a look at cash flows. Cash from operating activities also going up very nicely since 2011. They've been compounded at it's been compounded at about 14% per year. Stock-based compensation, it's been going up as well at around 13.4%. So now let's stop everything and check if and check the percentage of stock-based compensation relative to revenues and operating cash flows. And let's have a look. Right here. Share-based compensation as a percentage of revenue, only 2.24%. This is nothing. Okay, so the company doesn't issue a lot of shares, so it doesn't dilute existing shareholders, which is another big positive. Okay, let's continue. Cash from, so we have CapEx. Let's have a look at CapEx, which is investments in plant, property, and equipment. And you can see that the company so the company has been investing a lot, but remember that a lot of that is growth capex instead of maintenance capex. If I go here to Visa, to my stock analysis platform, to cash flows trailing 12 months, you can see that capex has been going up, right? So the company has been using well, the company is probably spending more to do what? To remain competitive. But you can use depreciation and amortization as a proxy for a maintenance capex, and so this is the number that we will be paying attention to. The rest is used to fund growth that will in the future translate into profits, or at least that should be the intention of the business. Okay, awesome. So I like what I'm seeing right now. That look at free cash flow going up even despite all the capex, they are still free cash flow is still exploding at 22 billion, and it's been compounding by about 14% since 2011. That's just, it's amazing to me. Okay. And sure enough, for all of that, Stock and Lock gives this company a 4.29 score out of 5, which is absolutely outstanding. Look at profitability, a score of 5, management, a score of almost 5, growth 3.83. Only the growth is probably the detractor here, and it's still at about 4. And sure enough, if I go to FinChat, I can see that analysts are projecting long-term earnings per share growth of about 13%, which is very good. And keep that in your mind, because I will use 12% as part of my growth assumptions over the next 10 years. Okay, so the company is great, right? Management seems to be aligned. In fact, now that we are discussing management, what is these guys doing, right? Do we have skin in the game right here? Let's see insider transactions, ownership of the company. Vanguard, what about show only company executives? I like to see what I'm looking at. Look at that, I like to see that. So Taneja Rahad, president of technology, owns about 76 millions worth of stock. A lot of skin in the game here. The same happens with vice chairman, 70 million. So you have a lot of people with skin in the game, if you ask me. And this is something that you like to see. Okay, you like to see. That said, I'm seeing I'm seeing insiders selling stock, and that is something that I don't like to see. There are many reasons why the insiders could be selling stock, so I don't read too much into this. But still, I would rather see a lot of buying, and I see a lot of selling. Okay, I see a lot of selling, as a matter of fact, and I don't see any buying. So keep that as well, because it's important to take that into account when assessing a company. And let's discuss now, because this company, let's discuss the valuation of the company on a relative basis. And for that, we will look at price to earnings and price to free cash flow. If I look at price to earnings, where is this price to earnings? Right here. Look at that. So price to earnings, the P of the company at the moment is 33, but remember that the forward P is about 18, I think, is it not? No, the forward P is about 25. Okay, so you can see that on a historical basis, the medium is about 32, and we are currently at about 33. The forward P is about 25. So look, on a price to earnings ratio basis, the company is not cheap. Okay, the company is not cheap, and so that's something to keep in mind. And let's have a look at the price to free cash flow. On a price to free cash flow basis, look at that. The median is about 27. Right now we have about 30 times, right? So it's not cheap either. Granted, there have been periods of time where you saw these outliers, but you also achieved the low of 16 times in 2011. But look at that. Since 2011, this thing has never traded on the cheap side. Yeah, because it deserves to be trading at a premium due to the consistency, the predictability, the capital light business model of the company that allows the business to deserve a premium over competitors, right? It's such a well established company, very reputable, very secure as well, and they have a grand brand reputation. All of those things justify pay a higher multiple. That said, you know me, I always believe that no matter how great the company is, they will go through periods of uncertainty. And this time for Visa, it may be AI going forward. I don't know. Maybe we will see more selling pressure, and but I will keep it on my radar. Okay. And now, look, let's run let's run a DCF, so a discounted cash flow, to see what exactly the intrinsic value of the company is. So great financials, nothing. The only red flag that I see is the fact that I mean, what's the red flag? I can't even remember, because the goods greatly outweigh the bads. What was the red flag? I can't even say. Growth a bit slowing down a bit, but that's. I mean, guys, they are still projected to grow at about 13% in today's market. I don't think that's sluggish at all. I think that's very constructive for a company that has been around for such a long time. Okay, but so let's run a DCF. We analysts, as I mentioned, are projected 13% growth over the very long term. I want to be more conservative, because you can see that Visa in the past 10 years and 5 years, they've grown. In the past 10 years, they've grown earnings per share at about 17% per year, and in the last 5 years at about 14th. So they have been a deceleration here. That's okay. But instead of assuming 13% growth, I'm going to assume 12% growth. Okay. And if I do that, and you know that I always want my 15% annualized return over the long term, which means that I want to double money every 4 to 5 years. That's my minimum acceptable rate of return. This is the free cash flow in year one. All right. So let's do that. And if the company can go on to increase its free cash flow at about 12% per year over the next decade. And if you want to double your money every 4 to 5 years, right, the price you should pay is about $150 per share. What's the price today? The price today is $285 per share. So do I think this is realistic though? Do I think the company will ever trade at such valuation levels? No, I don't, because for that to happen, the company would have to, I think they will have to crash, yeah, all the way back to 2020 levels, and I don't think that will ever going to happen. Okay, but sure enough, even based on all the metrics that I like to use, which are the field town valuation, field town, you can see payback time and 10 cap rate. Look at the 10 cap rate, 133 times. That's the price you should pay, in line with that DCF intrinsic value level. And the same thing goes for the free cash flow 8-year payback time of $150 per share, which is the price we should pay. So, look, would I be able to buy? Would I be willing to buy Visa at a price of $200 per share? It depends. I don't know. I always like my margin of safety, no matter how great the company is. And so this is something that I'm certainly not. I will keep it on my watch lists. For now, it's definitely a pass. However, from a fundamental standpoint, this is a great business, and probably a business that I'm or maybe I will never own it. I will never own it, and that's perfectly fine. I don't feel FOMO. I don't make decisions uh, uh, based on based on emotions. As you know, I will be very conservative with all my investments. And Visa does not tick the valuation box. It doesn't check that box. That aside, great fundamentals, great. They operate in a very attractive end market as well. And my analysis tells me that this is indeed a great company with skin in the game, that operates in an attractive end market, great company culture. I mean, the gap between Visa and its core competitives competition, its main competitives is just huge, because its main competitor is Mastercard, and together Mastercard, Visa and Mastercard, they, in all fairness, they operate in a duopoly. Okay, so I understand the premium. I'm just not willing to bend, and so yeah, I'll give it a pass for now. It will continue to be on my watch list, and I will be sharing this report with our members on our WhatsApp. I've already done so on school in our school community. So guys, if you find this helpful, just help the channel by smashing the like button. Share what we are doing here with other people that you may know and they may benefit from the value that we are creating here. And if you haven't done so, just you can reach out to me as well. It's by leaving a comment, sharing your constructive feedback, and don't forget that we have a free WhatsApp group and also school community. So the link will be show up. I will share the link in the description. So yeah, just join us, and I will see you on the other side. And looking forward to seeing you in our next live call on December 20th. Have a great rest of your Sunday.